right. Thank you very much, Paula, for those kind words, and again, thank you to the TMX for speaking. I am actually first up to speak, and I'm going to give a brief presentation about how to invest in a new bull market in gold. There it is. All right. So, I guess the first question is, and Paul alluded to this and stole some of my thunder in his opening remarks, but the first question you have to ask yourself, and if I ask this audience, the fact that you're sitting on a Thursday afternoon in July, that you're sitting in this conference, if I asked if we're in a new bull market in gold, I'm pretty sure I'd get 95% of the hands to put their hand up. But we think so, and I'm going to give you. There's lots of reasons why everyone says we are, but I'm going to give you two that I think are important. First, historically, and that's what this chart shows, in environments of negative real rates, gold acts like a currency. In fact, you can see from this chart where you have negative real rates, you have gold outperforming. And that's simply because of the fact that your normal assets are effectively negative yielding, and so gold at zero yield looks really good. The interesting thing, and obviously this is something that Ray Dalio highlighted in his comment yesterday, is that there's actually $13 trillion of U.S. government securities, 13 trillion U.S. of government securities that have negative yields right now, negative nominal yields, not even negative real yields, negative nominal yields. So investors are buying them to pay the government to have that low risk. So it is a different environment, but again, gold is a zero yielding asset effectively, and so it makes it more attractive in this type of environment. The second thing is a lot more obvious. People are buying gold. This is usually the telltale sign that we're in a bull market. The psychology shifts. So in the last month and a half, almost $5.5 billion has gone into the GLD, and that's an impressive amount when you think about the size of the gold space in general. And so typically this is the first move. You see, people are like, well, I don't have any gold exposure. Easiest thing to do is you look up the GLD ETF and you buy some, and then it starts to work its way down to the company ETFs, and then it works it down to the individual companies. And so we think we're just at the beginning here, and that's what this highlights. It is certainly first mover advantage. So while it is a Golden Summer Conference, I do want to put this out there. What about silver? And the tagline there is, this time it's different. And as you guys all know, often as soon as you utter those words, you make a bad investment decision. And so I'm going to tell you that our view is that it's not different. Right now, silver's at it's actually down a little bit from this. This presentation was dated on Tuesday, so it's 92 times. The gold-silver ratio is at 92 times. Historic average is 66. I can't tell you for sure that it's going back to 66, but if history is any kind of repeat in a new bull market, we are going to have silver outperform, and that ratio is going to come down. So while we are talking about gold names today, I think silver's ready for its move. And when I did put this presentation together on Tuesday, I didn't know silver was going to move yesterday. So that's certainly positive. So now that we all agree that we're in a new gold bull market, what does a bull market look like? And what are the companies that outperform, and what does it look like? So we've pulled a couple of the last bull markets, and some of us are old enough to remember when this happened, and some of us aren't. If you look, so this is April 1st, 2001 to December 2004, and this is broken down by market cap. So your black line is the S&P 500, your red line is the gold price, the green line is your billion-plus dollar market cap companies, the gray line is your sub $200 million companies, and the sub $1 billion to $200 million, my apologies. The blue line is $200 million to $1 billion, and the gray line is the sub $200 million category. And what this chart shows, and what you can see here, is that early in the cycle, everything moves together, and then in the end, the small miners outperform. Now this is an exceptional situation. This is off the tech bubble post a Bre-X-induced destruction of the mining industry. So everything was in really bad shape at that moment when the market turned. Maybe a little bit better example and maybe we're somewhere in between these two places, is the 2009 to 2011 bubble, where the major gold companies were in a little bit better shape. So again, we have the same color code, and you can see that early on everything sort of moved together, and then immediately the smaller cap companies outperform, which I think is a key thing for us. I mean, this is our view is that if you as a new bull market develops, you want to be in smaller cap companies, and why is that? And our view is our view on this is relatively simple. Risk capital is what funds early stage exploration, and that's what comes into the market in a bull market, and that funds that exploration, and new discoveries are made, and that goes ahead. But because there's been so little capital put into exploration, a lack of exploration spending, a lack of discoveries leads to a lack of discoveries, leads to a lack of new mines, leads to declining reserves for the majors, and at the end of the cycle, as the cycle progresses, the question is going to be, where is your growth coming from? And it'll be the juniors who have had some risk capital put into them that are going to be the ones that get taken out. So that's how the cycle repeats itself, if you will. The interesting anecdote here is I had a fund manager ask me, will the majors be more disciplined this time around? And they might be. They might make better decisions, but they are still going to have to buy stuff at the end because the reserves are still declining, and so you're still going to have to see that growth. I don't know if we'll see another redback type transaction, or at least not in the at least not at the beginning of the cycle. So now that we've talked about that we are in a new gold bull market, that sort of what that bull market looks like, you say, okay, well, a rising tide floats all boats, so you could, take a lot of shots. Well, some boats are better than others. There's probably 1,500 TSXV listed junior mining companies. Of those companies, you could probably pick out 150 to 200 that really have real projects and real assets and are moving ahead, and then probably 50 to 60 that we probably that we like. So there's three keys for picking. I'm going to give you three keys for picking junior mining stocks that I see. Now, I'm going to make this point first, that before I get to the three keys, don't forget about the fundamentals. Like any good business, whether you're picking a tech company or a cannabis company or whatever, management and balance sheet matter. Does the company have, is it a good management team? A good management team can make an okay asset great, and a bad management team can make a good asset bad. And so I think that's always key. And the second is balance sheet. Oftentimes, companies have great ideas. They might have a great project, but they don't have a capital structure that you can actually raise money in to move it ahead, or they don't have, or they have exceptional growth opportunities, but not the the cash flow to actually fund that growth. So it's important to know that that balance sheet's in a shape that will actually support what this company wants to do. So now on to the three keys. The first is scarcity. There's three key points here. Good projects, great projects are very rare. You could probably do a poll around the room. We could talk about the last 3 million ounce deposit that was discovered. And it's, in the last 5 years, I don't think there has been one. Perhaps there has. It isn't quite 3 million yet. But there's very few new great discoveries that are made. So great projects are very rare. And because of that, if anyone's got a great project, that's great. And what you're looking for, the reason 3 million ounces is that's what a lot of the majors look for. We do a lot of work talking to majors and their corporate development teams, and a lot of them talk about plus 3 million ounces being the number. The other thing to look for in the other thing that is scarce is decent projects in premier jurisdictions. If you look at the last cycle of M&A before before majors buying majors, it was all good jurisdiction projects that got taken out. Whether it was Integra or Kaminak or Claude or Lakeshore or Newmarket, those are Canadian and Western and Australian projects or companies, and so it doesn't have to be as good when you're in a premier jurisdiction, because your risk profile is a little bit lower because of jurisdiction. But decent projects in good jurisdictions are also rare. And then lastly, and it is a gold conference, but this is something that we've seen a lot of activity on in the markets. Large-scale copper gold projects are incredibly rare. BHP, Rio, Newcrest, they are all chasing assets right now. And I think that's an important point. And I think the thing here is that if you look at the recent history, Newmont investing in GT Gold, Newcrest buying 70% of Red Chris from Imperial Metals, BHP and Newcrest chasing SolGold with significant equity ownerships. The majors are looking for these projects, so consequently, when you're looking at a junior miner, you should be looking for that opportunity as well. The second thing that's very characteristic of a bull market is that good news is good for stocks again. So the key thing is does that company, and I'll highlight this, this is something that happened on Monday. So Brixton Metals, representing a little bit later here, put out a great drill hole, 555 meters at just under 2 grams gold equivalent. And the stock went up, at one point it was up about 90%. That's what you expect from a great drill hole. The stocks go up. It's not a liquidity event. You don't have people blowing out stock into it. And so if good news is good for stocks again, then the company that you're looking at has to be able to generate that good news. Are they going to be able to get the capital? Are they going to be able to, do they have the projects that are going to deliver that news? And I think those are two key things to look at when you're looking at that junior mining stock. Are they going to have that good news that you need to generate those returns? They're not all going to look like this, but even incremental good news is good. And then last, what is the potential of that project? Especially when you start looking at development stage projects and exploration stage projects. Is it big enough? Is the resource size going to matter to somebody? Does someone going to want to take this out? We talked about the plus 3 million ounces. That's for the majors. The mid-tiers can go a little bit smaller than that and be very interested. The second, if this thing becomes a mine, does that cash flow matter to somebody? Is it big enough that it moves a mid-tiers, it's going to move a mid-tiers multiple up, or move a mid-tiers valuation if they acquire it? So those are the ways to think about it. And I think there's actually a really simple test for that. It's you don't have to go through and do a detailed model. Is there something out there that looks like this that someone else bought already, right? If you're looking at 500,000 ounces of heap leachable ounces in Nevada, there's a lot of people out there that are chasing that project. Those are real. That's a real thing. 1 million ounces in Northern Ontario, same thing. So I think that there's people out there who want that. The second part of that is it in production in the world? Is it in production somewhere else in the world, right? Does something look like this that is already in production? I think those are sort of the key. It's a simple test to figure out whether that project is worthwhile or not.